Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
I feel like I should be listening to the Welcome Back Carter theme. I'm sure a lot of you are coming back from well-deserved summer vacation, so welcome back. I know that I missed the July call and you had a substitute host in Greg Domville. I heard he did a fantastic job. And here we are with a predicted Bank of Canada position by our chief economist, Dr. Sherry Cooper, where we saw no change in the Bank of Canada rate. And Sherry, I think you called this one. I mean, it was something where you've been talking about it. And by the way, just so you know, I believe you were right on the last 11 changes. You're right on 10 of them. You missed one. So, you know, you got this economy thing down pat. So good for you. We also heard today from the Bank of Canada on a couple of fronts, and you know, one of them was that the economy unexpectedly contracted in the second quarter, which, you know, I think is no surprise since they're raising rates to slow down the economy. Isn't that what you've always said?
Yeah, sure. And what was the surprise was the first quarter growth number, right, originally posted at 3.1% with very strong consumption. Interestingly, they rethought those numbers. They do typically revise numbers as time goes on, and they revised that 3.1% growth rate in the first quarter down to 2.6.
Right.
So basically, we've seen incoming data that shows that the excess demand in the economy has diminished. It may not yet be over, particularly in housing, but nevertheless, things are moving in the right direction as far as the Bank of Canada is concerned.
Love that comment. Yes, listen in. Dr. Sherry Cooper is one of the best. So we're glad that she's with us here today. So Sherry, as usual, we'll go through your entire presentation before we take any questions, but we do want to see your questions. So don't hesitate, type them in there. I will get to as many questions as possible. So we're going to hand it over to Sherry so she can go through her presentation now.
Well, great, Eddy. Thanks very much. Of course, everybody wants to know what happens next. We all know what just happened. So how close are we to the peak in interest rates, and when will they start to fall? Well, to do that, let's take a look at what actually is going on in the economy. We've seen, of course, that the slowdown has finally begun to happen. This year, the growth pace, now I'm forecasting it roughly 1%, certainly well below the 3.4% that we saw last year. And when you look at these quarterly numbers, you see that in the most recent period, the data that were released just September 1st, last Friday, the growth pace of the Canadian economy actually dipped into negative territory. We moved from 2.6% growth to minus 2% growth. We saw this slowdown coming. It was evident in the consumer sector and in business spending as well. And we also saw a substantial decline in net exports, which could well have forecasted the slowdown that we are seeing now in the Chinese economy. The good news is, as we go forward, the forecast is coming in at a level that could well keep the Bank of Canada on the sidelines for the rest of this year. Now, that's uncertain, of course, because anything in the future is uncertain, and more so these days than ever before. But what I do believe is that we will see virtually no growth for the rest of this year in terms of economic activity. In any event, though this is likely to happen, there are other forces at play outside of Canadian economic factors that will affect the inflation rate. And it is inflation that the Bank of Canada is targeting. We know that households are very vulnerable to increasing interest rates. This shows you debt to income for households. It's at a record high level. Now, the good news is that much of that debt is in mortgages, backing, of course, homes, and that house prices, though year over year, they're still down slightly, about 1.5% as of the end of July. The fact is that there is an enormous amount of equity in homes that are owned. And that equity has meant that household net worth has increased very, very sharply. So household balance sheets are still in good shape, even though we have seen a 1,900% increase in interest rates. 1,900% in the overnight rate. Unprecedented. Honestly, never before have we seen interest rates rise by so much, so fast. We went from 25 basis points when they began to tighten monetary policy in March of 22, and now, of course, at 5%, that is a 22-year high in interest rates. As a direct result of the dramatic increase in rates, we've seen a substantial decline in household credit. Household credit market, this shows you the first quarter. The second quarter data will be out in the middle of this month. But year over year, mortgage originations were down a whopping 42%. Below pre-pandemic levels. Hardest hit were the first-time home buyers, not surprising. And it's likely, in fact, that we will continue to see relatively low mortgage originations until and unless the markets believe that tightening is behind us. And that's exactly why the Bank of Canada's press release today and the comments made by the Bank of Canada are very hawkish in nature. In other words, the Bank of Canada is telling us that there's still a good chance that they're going to have to raise rates again. And they are telling us that because if we did hear from them that they've likely hit the peak in rates, bond markets would rally, long-term interest rates would fall. That would mean that fixed mortgage rates would clearly decline, and the housing market would be off to the races again, which is similar to what happened when they paused interest rates the last time, and we saw a burst of activity in April. They don't want to see that happen. They want to keep us in a slow growth mode, certainly through the rest of this year and into the first half of next year. And that doesn't mean they have to raise rates again, but it has to mean that we still believe there's a chance that they might do so. So it's a psychological game they're playing, but it's a very important one. Now, we have seen that just in the last data release in the second quarter, that consumers are tightening their belts. We've seen a slowdown in consumer spending, even for services, and an uptick in the savings rate. Households increase their savings when they're feeling uncertain about the future, when they're being more cautious. And many households are vulnerable to these higher interest rates, largely because mortgage renewals are beginning to pick up. The renewals for the remainder of this year are, for mortgages that were taken out, originated 5 years ago. Right now, if interest rates stay at roughly current levels for the remainder of the year, we would see that the mortgage interest rate for those renewals would likely be double the level they were prior to renewal. So on average, they were about 3% mortgage rates 5 years ago, and now they'd be about 6%-ish. So that doesn't mean, by the way, that the actual monthly payments double, because in the past 5 years, many people have paid down a good deal of the principal. But nevertheless, you can see this is why monetary policy works with a lag. It takes a while for the effect to show through as mortgage renewals increase and peak in 2026, 5 years after that boom in housing we saw in 2021, when the central banks around the world took overnight rates down to nearly zero. So we will see a continuing effect of tighter monetary policy. Consumer confidence has fallen. We see that consumer confidence is down. These are monthly data, and they're down in August considerably. This is exactly what the Bank of Canada wants to see. And as a direct result of this could well keep the Bank of Canada on the sidelines. You can see that in particular, first-time home buyers have been squeezed as the average loan amounts for first-time home buyers continue to rise. Yes, it is true that home prices declined over the course of the second half of 2022 and into the first half of 2023. But year over year, those price declines are really very modest. And the interest rates skyrocketed. Credit card delinquencies are rising. Many households that are feeling squeezed financially have turned to their credit cards in order to make ends meet. We all know how much food prices have gone up. And unfortunately, a lot of people are unable to pay off their credit card balances, and delinquencies are rising. That's a leading indicator. It typically leads a slowdown in economic activity, just as we have seen. Also, we've seen a marked uptick in business and consumer insolvencies. Again, a leading indicator of recession. But the job market has certainly been a focus of the Bank of Canada, and the job market came out of the lockdowns in Canada raging. We saw that as the economy opened up, the unemployment rate fell very sharply as employment increased very sharply. Now, as you see in the latest data in July, we actually saw a net decline in employment, and we also saw a significant uptick in the unemployment rate. So the unemployment rate is now at 5.5%. Now, though that is up from recent lows, it compares to 5.7% right before the pandemic began. So it's not a high level of unemployment from a historical perspective. Unemployment rates are still low historically. However, what we are seeing is an easing in what was very, very tight labor markets. And that has also been reflected in a significant decline in job vacancies. So all of that is exactly what the Bank of Canada wanted to see, and it is coming true. We also see that the ratio of unemployment to job vacancies is now rising, another indicator of economic slowdown. In addition, the massive increase in immigration, bringing so many new people into Canada, increasing our population to a level of now over 40 million people, has also helped to fill these job vacancies. You can see, though, that wage inflation is still a concern, and the Bank of Canada told us today that the pace of wage inflation is one of the key factors that they'll be watching to determine the course of monetary policy going forward. We see that in the last data available for July, that the wage numbers increased again with a 5 handle at 5%. We'll get a new employment number this Friday. So hold on to your hats. There's more to come. Between now and the next meeting of the Bank of Canada, which is on October 25th, we'll get 2 more labor market readings. Very important to watch those to determine what the bank will do next. There are headwinds in the economy. I told you consumer confidence is down, non-mortgage debt is rising, credit card delinquencies are an issue, monthly payments on floating rate debt, like adjustable rate mortgages or home equity lines of credit, have increased very significantly. And we're beginning to see an uptick in the 30-day non-payments of mortgages. It's very early. I don't think that we're going to see dramatic increases in mortgage delinquency rates because the economy, though slow, is still running in a year-over-year percentage basis that is not at all suggestive of deep, long recession. Now let's look at the inflation numbers. Last month, we did see an uptick in inflation. We expected that. It was largely the result of the year-over-year base effect. A year ago, inflation in July of 2022 had already fallen from its peak. So the year-over-year comparisons are more difficult than what we've seen in the past 8 months. And that factor will continue to show up in the next couple of months worth of data. It is likely that we will see inflation, CPI headline inflation could rise to about 4%. And it will be interesting to see how the Bank of Canada reacts to that. The factors that would contribute to an uptick in inflation, again, are these more difficult base effects, but also some fundamental changes. Gasoline prices, for example, in the month of August have increased sharply, even more than what you'd normally expect on a seasonal basis in the month of August, where driving has always picked up sharply as people head for the beaches and other vacation communities. So this base effect is something that the Bank of Canada will look through, meaning they understand it doesn't mean that actual inflation is rising. It is just a statistical artifact that is causing the uptick. But of course, there are fundamentals. We know that the increase in mortgage costs year over year has been nearly 31%, and that does feed into the CPI. But the Bank of Canada, in making their decisions in terms of future monetary policy, will look through those data, excluding the component for housing in the CPI. The actual cost of living increase has only been 2.4% in the month of July. As well, we are seeing a dramatic increase in rents. And again, both of these factors are the result of shortages in housing. So you combine the massive influx of new people and the fact that they need to live somewhere, demand for housing, be it for purchase or for rent, continues to rise sharply. And that has caused, given the sticky supply, it has caused an uptick in rents. Another factor contributing to what's going on in housing is that many of the investors in housing that are now landlords and increasing these rents are trying to cover their carrying costs. But as mortgage rates have increased, and especially for variable rate loans, they are not, even with higher rents, covering their carrying costs. And there may be some dislocation as a result of that. There will be some landlords that will no longer want to carry these loans and put the properties on the market. We did see an uptick in new listings in the month of July. So another factor that has been hugely important in the inflation story has been food prices, both the food that you buy in grocery stores, but also in restaurants. There, the food inflation numbers are very high, even now, though they've come down sharply at 7.8%. The Bank of Canada will watch that. The good news is that the supply chain disruptions are easing. And we're also seeing a lot more onshoring, meaning that manufacturers are using inputs produced locally or from friendly nations rather than importing everything from Russia or China or regions in, very far away, where we learned the hard way during the pandemic. We are subject to tremendous losses of inventory when you cannot replenish them as a result of either dislocation, disruption, not just pandemic, but also the Ukraine war had a huge effect in that regard as well. Now, the bank will continue to look at their different measures of core inflation. This shows you the CPI excluding food and energy, and there we see inflation still above 3% at 3.2, but it certainly has decelerated sharply. And then the other measures of core inflation that the bank looks at have also edged down, but still, again, they're above 3%. The most important measure for actual inflation is looking at the 3-month moving average of core inflation. In other words, not year over year, but what's been happening over the past 3 months. And there we see core inflation has dipped just slightly. I think it's safer, really. It's more accurate to suggest that core inflation in a 3-month range has been pretty flat. So the bank is looking for a dip in core inflation before they're willing to issue a much more dovish statement suggesting to all of us that rates may well have peaked. By the way, we will see 2 more inflation reports before the bank announces once again on October 25th. So today, Bank of Canada held rates steady, a surprise to no one. Ever since last Friday's GDP figures, every major institution in the country with the chief economist had changed their view because a few of them had expected another rate hike today, saying that the Bank of Canada will hold rates steady. It's also interesting to note that the bank continues to reduce its balance sheet. What that means is they're letting their holdings of government bonds and mortgage-backed securities run off. And that in itself tightens monetary policy because it reduces the liquidity in the marketplace. So the bank is on hold, and the housing market, of course, is the most interest-sensitive sector in the economy and reacts the most aggressively as a result of monetary policy. So there are 10 increases in interest rates over the past 18 months, and we're holding steady at the highest level for the overnight rate in 22 years. The prime rate will remain at 7.2%. And we've seen that the 5-year government bond yield has trended higher ever since the bank started tightening. That yield had moved above the 4% level in recent weeks, largely the result of stronger than expected economic data in the United States. But more recently, those numbers have edged down. Right now, the 5-year yield is just shy of 4%. The 5-year yield is important because it helps to determine the fixed mortgage rates in Canada. And we've seen those mortgage rates rising even when the Bank of Canada held steady. So what did happen in housing markets? Well, you remember in June and July, we saw unexpected increases in overnight policy rates by the central bank. And that spooked the spring housing season and slowed the housing markets in June and July. The housing market, the sales numbers anyway, fizzled in June and July as a direct result. This shows you overall sales activity nationally across the country. And you can see that the July number was basically equivalent to what we saw in the prior quarter. August sales, which have not been released yet, but preliminary evidence is that August sales and price growth showed signs of weakening after those two BOC rate hikes. Now, in the latter part of August, and this is all just anecdotal, it appears that we may have seen some pickup in activity, but in the next week or so, we'll begin to see the preliminary data from the regional real estate associations. As well, we'll get to look at another 2 housing market reports before the next meeting of the Bank of Canada. One piece of good news is that new listings did increase rather sharply in July, up 5.6%. And that did help because inventories of available housing have been extremely low. Right now, around the country, on average, we're close to balanced markets from a buyer versus seller perspective, but it varies regionally quite a bit. This shows you home prices, again, on a national basis, using the MLS home price index, which adjusts for the variability from month to month in the type of housing that is transacted. Here you see we had a big decline in home prices when the bank began to tighten monetary policy, but on a year-over-year basis, we've almost wiped out the decline that we saw when you look at the national averages. Home prices did increase in July by about 1.1%, and the majority of local markets had price increases in June and July. So potential home buyers and renewers of mortgages are pondering fixed versus variable. What should they be doing? This is ever the question, but clearly now more than ever, we've seen major shifts in sentiment. Back in 2020, in July of 2020, new mortgage originations showed a peak in the share of variable rate loans relative to fixed loans. And that peak was a whopping 57% of all new mortgage originations in July of 2020, 3 years ago plus, were variable. As of the latest data available, variable rate loan share rose to 13% in July. That's up from 8% in April, but still fixed loans are the predominant share of the new originations. And you can see that the 3 to 4 year terms for fixed loans are in fact the most popular, suggesting, of course, that people do expect interest rates to come down, but maybe not in the next year or two. So, as time goes by, as we see finally inflation moving towards the 2% target, I think a lot of people will then once again consider rates are going to be falling and variable rate loans will once again become more attractive. I don't think, though, that we're going to get back to a 57% share of new originations because so many people have been burned. And as well, even though interest rates will certainly fall in the future, they will not return to the pre-pandemic levels that we saw. And the reason for that is we are no longer in disinflation. On average, in the 5 years prior to the pandemic, inflation was below 2%. Very unlikely to see that again. And that's because of broader global changes. Globalization, in fact, is in reverse. We're onshoring a lot more production. The US is opening up facilities to produce their own semiconductors. Same thing's happening in Canada. In addition, there's another big factor that is going to add to price pressure, and that is all of the initiatives taken to deal with global warming and move from fossil fuel driven economy. So electric cars, for example, no question will be more expensive, at least in the early days of the new innovation. And it will cost governments money. It will cost in terms of greener, both greener production, greener consumption. We're even paying now for those not plastic bags at the stores these days. So that does add to price pressures, and therefore it means that interest rates do not go down to the overnight rate of 1.75% that we saw prior to the pandemic. I think the overnight rate will fall probably by the middle of next year. We'll begin to see rates declining. But the Bank of Canada, along with the world's central banks, barring some unexpected catastrophe, will gradually reduce interest rates, kind of 0.25% at a time, and maybe not every month as they meet. So it'll take a while to get to whatever the new normal overnight rate will be. But in my view, it will be closer to 3% than to the 1.75% we saw in the past. Now, what's really troubling for many is the rate pain for those with upcoming renewals, and not just so much this year, but the renewals coming in 2024, 2025, 2026, where interest rate pressures will be huge, and maybe more importantly, where principal balances have increased sharply, because so many people having all those variable loans have hit their trigger points, and they have not been able to not only pay down their principal, but in many cases they're not even covering their mortgage interest payments. And as a result, many of the lenders have increase the amortization. So negative amortizations, meaning that those mortgage balances have actually increased. Now, OSFI is pressuring the banks to return to original mortgage amortization levels, roughly 25 to 30 years, when they renew. Now, that will not be the case for households who truly cannot afford it, because there's also political pressure for the banks to work with those households to assure that if at all possible, they can remain in their homes. But without question, as we get to 25 and 2026, the monthly payments for homeowners will be rising. The Bank of Canada made an estimate of that for variable rate borrowers, those that borrowed in 2021 when interest rates were so very low are likely to see as much as a 40% increase in their monthly payments. For fixed borrowers, it would be more like 20 to 25%. Now, they've had 5 years to increase their income. And I do believe that, as most banks have suggested in their most recent earnings reports, that the bulk of borrowers are able to stomach these kinds of payment increases, and many will be opting to make lump sum payments over the next couple of years before renewal, if they haven't already done so. So it's not a disaster, but it's certainly another factor that explains the lags in the effect of monetary policy. Now, the regulator for the financial institutions, OSFI, has been very open about its concerns about the negative amortizations, as well as the risk associated with mortgages for people or households that have more than 450% loans relative to their income. And it's a two-track system. What OSFI's done thus far is increase capital requirements twice for the banks in the last 6 months. And these capital requirements are based on risk-weighted assets. And the bigger the actual principal relative to income, as well as the longer the amortization period, the higher the risk weight. So in other words, the more of those mortgages that banks put on their books, the more capital that they're going to have to keep basically locked up idly, and that reduces earnings. So banks we've already seen becoming more prudent in their lending practices. In other words, credit has become more difficult to attain rather than credit is easily available. And no doubt that will continue through 2024. Now, the share of new mortgages, and this is, keep in mind, not existing mortgages, but new mortgage originations with loan-to-income ratios above 450% has plummeted. That's what I mean. It's not because people are in so much better shape. It's because the banks won't make loans to people with that level of income, too low a level of income. Now, one of OSFI's proposals for the future is to limit the overall proportion of these risky loans to 25% of the total mortgage book. I don't know if they'll actually put that in place. And it's very difficult to measure, really, because incomes fluctuate so considerably, and whether or not these would be calculations made on a forward earnings basis rather than an historical earnings basis is also a question mark. But nevertheless, just suffice it to say that OSFI is breathing down the necks of the federally insured institutions, and that this is exactly what the Bank of Canada wants to see. They want to see less credit available, which reduces spending and therefore reduces inflation. And then fundamentally, though, as much as they don't want to see home prices rising, the fact that there is a huge shortage of housing, which will only get worse as more and more immigrants move into Canada, suggests that home prices and housing demand will continue to be in excess of supply. This shows you the huge population growth in Canada, the strongest in the developed world, and as well that I've said this many times before, that the government sticks with their forecasts of wanting to see 500,000 new Canadians coming into the country based on their economic immigration. This doesn't even account for the more temporary workers that are moving in or the refugees. So at least 500,000 new workers into Canada. Now, there is good economic rationale for this because the baby boomers, the largest generation in the history of Canada, are now retiring. The youngest boomers are hitting age 60. And this means that in many, many sectors, construction is one of the primary ones. There's a shortage of labor, and especially trained, talented labor. So bringing people in that already have this training and talent makes sense. The rub is they need a place to live. And to date, I've not seen any evidence to suggest that we're going to be successful in the next decade in producing sufficient numbers of new homes for the demand and supply to equalize. In addition, another factor that's making this even more difficult is just the surge in the cost of construction. Some of it is basically wage related, some of it is price related, some of it is basically a result of the sand in the gears coming from municipal development fees, coming from zoning restrictions, the environmental impacts, not to mention the forest fires that have consumed something like 25% of the landmass of Canada. So right now, these are big, big problems. No doubt it will be a feature in the next federal budget, but it is not the feds that control this. And at the local levels, there's a whole lot of discussion, but not a whole lot of action. And especially, it'll really be interesting to see what happens in the Toronto region with a new mayor who has made a lot of promises about affordable housing. So, and looking at the housing starts data, we did get a spike in June, but it has in part retrenched in July. I mean, by historical standards, these would still be considered reasonable housing starts figures. But when you're looking at them with the perspective of future population, they are woefully inadequate. And then my last slide, just to suggest that this immigration does boost economic growth, no question about it. But on a per capita basis, we're not seeing growth. Per capita, we're actually seeing a diminishing returns. Part of that is because the productivity growth is falling. And it's not just a Canadian phenomenon. Productivity growth has slowed considerably pretty much everywhere in the developed world. But new technologies, as they begin to be embedded in our output, will help to improve that. One of the most controversial as well as very, very important new technologies is, of course, the addition of these large large models that have artificial intelligence capabilities embedded into pretty much everything. Everything except where we have the highest labor shortages, which is in healthcare and in the just general care, be it from childhood to elder care. There's enormous shortages, and that is a very much face-to-face kind of employment where artificial intelligence is not the answer. So lots of food for thought for coming issues and reasons why we do need more people in Canada, but it just means the housing markets will continue to see explosive demand and increased supply, but not enough to deflate prices. Thank you, Eddy.
Okay, Sherry, thank you. That's a lot of information. Before we get to our questions, which will be rapid fire because we're already at 20 after, I wanted to first thank FCT for sponsoring our call today. The great people at FCT, thank you so much. I also want to talk about those renewals. It's really important that if you are coming up for renewal, that you don't just sign back the renewal. There is some room to negotiate, and the absolute best way to negotiate is with a DLC mortgage broker. So go to our website, ensure that you find a local DLC mortgage broker near, help you with that renewal to make sure that you're getting what you deserve, which is the best rate possible. Also, we are entering into a fall market. What does that mean? Banks will fight for market share. They do it every fall, mostly because their year end, as you know, Sherry, is in October. They have a new
October
year.
30th.
Yeah, they have a new year in November. And what do they want? Well, they have to make up numbers. So this fall campaign sort of market is really important because lenders will fight for your business. So please contact your DLC mortgage broker. They'll help you with your renewal. Really, really important. Okay, we have a ton of questions, but the one thing I want to ask you is in your report, you talked about these letters from the premier going to Macklem to, plead, don't approve mortgage. Have you seen that before? I know Doug
No.
Sunday. The other ones all last week. Have you seen that before?
No, I haven't. Of course, remember, since I've been in Canada, which is since 1983, interest rates have fallen. So maybe there was no need for them to lobby the Bank of Canada, but certainly they're very worried. And it's also on them, the premiers, to make housing more affordable, because that's going to be a big political issue in any upcoming election. So they absolutely want to see easier money, but Bank of Canada is independent and they'll do whatever they think the incoming data warrant.
Yeah, that's fair. Okay, let's get to the questions. First one: could the Bank of Canada be forced to raise rates if the U.S. Feds raise rate? Is there a correlation there?
Well, there's always a correlation in terms of market-driven rates, and that's why we saw the 5-year yield move above 4% recently, because U.S. data were very strong. But in terms of the policy rate, if our economy is slower than the U.S., and if our inflation numbers come down faster than the U.S., the Bank of Canada would not follow the Fed with higher rates. But the fact is, we do veer away from the U.S. at times, but never for very long. So, I mean, I don't think we have to worry about the U.S. being overly tight and therefore we can't ease. I guess I basically think that both economies will trend in the same direction ultimately.
Okay, there's that. That's a pretty good comment. The next question's around supply chain when it comes to food and oil. We know the Ukraine war still going on, climate change. Would the BOC do, what would they do with rates if that's the case and supply chains keep on getting disrupted? Ukraine war keeps going. Will the Bank of Canada react?
Well, not unless there's some kind of, crisis that we don't have yet. I mean, if anything, Ukraine has done an amazing job we thought the war would be over in 2 weeks, and here it's a year, much more than a year. And the Russians, if anything, seem to have continued to have serious problems, both in terms of, their ability to fight and what's going on at home. So, no, you see, it's never what we already know about that shocks the system. It's always something we don't know about. And so we need a shock to the system to have some major disruption in interest rates in the economy.
Right.
And none of us know what that is by definition, or it would be in the market, if you get what I mean.
Yeah, no, absolutely. Let's talk about fuel prices. They've gone up in the last month, which doesn't reflect in the inflation percent at this time. Will that lead to higher inflation numbers by next?
Yes. And the Bank of Canada said that today.
Okay.
And, so that's why I'm telling you, don't be shocked if you see a 4 handle on inflation for August. And will the Bank of Canada tighten as a result of just that? No, I don't think so. But if it's also accompanied with stronger job growth and stronger economic activity, because we'll get a couple of monthly GDP numbers, it's possible. And there's some people that are already forecasting an October increase in rates. Not me, but there are some.
Thanks, Chief, for that question. Okay, this one is interesting because you talked about fixed rates over variable, with the speculation that rates could start to go down in the second half of 2024. Was it in your thoughts around recommending variable rates to clients? So this is a good debate, and I think this debate is important. This is why, talking to a DOC mortgage broker is going to help you, because they can take your situation in the whole and not just speculation, and ensure that you are getting into the right product, be it variable or fixed. But in saying that, would you be recommending maybe variable a little bit more than fixed, knowing rates are going to go down, or you love the safety?
Well, I mean, it depends on your risk profile.
Yeah, exactly.
It depends on just how much you want to bet. And do I think interest rates are going to be lower 1 year from today than they are right now? Well, okay, so the fall of next year, if they're lower, they're only going to be a bit lower. I don't think they're going to be a huge amount lower.
Yeah, no, I mean, that's fair. That's fair. I mean, we'll have to see. It's all data dependent, right? We're going to talk about, the last question I'm going to ask you is about rates. But before that, we got a couple more. So will quantitative tightening help keep the fixed rates higher, thus acting as a means to fight inflation, but allow the Bank of Canada to keep the overnight lending rate as is for an extended period of time? So
that's the theory. That's the theory. I mean, that's what they're hoping. That's what I'm hoping. And that's exactly what should be happening. All other things constant. But all other things are never constant. So, and if it were easy, none of us would need to do this job.
Right. 2 more questions, and then we're going to wrap up. Will there be a recession next year?
I don't think so. And by the way, a recession is not 2 consecutive quarters of negative growth. Everyone says that. That's not true. A recession has a much broader definition than that, because it's not determined to be a recession until this group of assigned economists get together and determine that. And there's many criteria that there has to be more than just a little negative number. You have to see a contraction in economic activity, in consumption, in investment. You need to see much higher unemployment. It's a whole series of things. So, we got minus 0.2% growth in the second quarter. If we get minus 0.2% growth in the third quarter, are we in a recession? No way.
Yeah.
That's not it. So
the economy is proving to be resilient. Like there's still like the job market. They talked about inflation and wages. That's still going on. So there's still some resiliency to get through. Okay, so last question. It's about what's going to happen next. Do you see decreasing rates in the future? You said you have. Let's talk a little bit about that. When will rates start to decrease? Sherry Cooper.
Again, given what we know today, probably by the middle of next year.
Yeah.
I'm reading a book about quantum physics right now. And
okay.
I do have a life, but it's actually quite fascinating. It's a layman's book. I know nothing about quantum physics, and I'm reading about it. And what it says is basically the basic like the whole thing about quantum physics is everything reacts to everything, and it's possible to determine. It's not deterministic. Nobody knows. It's all probability. So, how could this possibly be a guarantee? It can't.
Well, here's what we do know, that there's 2 more inflation reports to the next one. So that's going to determine what you're going to predict, because you've done that. You've used data to predict where rates are going to go. So we'll wait for those, and then we'll hear from Dr. Sherry Cooper where we're going to be with the next Bank of Canada, which is October 25th. So please tune in. We really appreciate your support. And a big thank you again to FCT. You guys are incredible. Thanks so much, Sherry. As always, you are amazing. Thanks, everyone, for tuning in. Until October 25th, we'll see you next time on ICW.